Hi there, everybody. This is Patrick Zielbauer from Infinity Futures. It is 3:30 in the afternoon on Monday, April 16th. Thanks, everybody, for coming to the event today. I apologize. I don't have a great voice today. In fact, it might impact how long we go. Apologize in advance for that if we do have to cut it a little bit short, but um, I'm sure you can hear it. Today, we're going to be covering some aspects of Sierra that we covered a little bit last week as well. I'm going to go into hopefully a little bit greater depth. And before we do, I would like to read some risk stuff, answer some questions related to risk, and just get us going. All right, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So, folks, only fund a futures account with risk capital. All right, that is money you can afford to lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle, pay the bills, etc. All right, also be ginger with respect to your use of day trade margin. You hear that thrown around in our business a lot. Even if you use the regular overnight margin per contract, you're still using quite a bit of leverage in most cases. So if you're not sure about what this means or if this is appropriate, please feel free to have a conversation with your rep in our office here. Everybody here has one, whether you're a customer or a prospective customer of ours, and certainly we would be happy to have an objective discussion with you about risk. We're happy to do that. All right. My name is Patrick Zielbauer. I'm an AP or associated person of Infinity Futures, and we welcome you to the event here today. Most of you are customers here and understand that Infinity does offer and do an excellent job supporting Sierra Chart, which is a program that we used to offer many, many years ago, sort of like as a third-party basis where you would lease it with a credit card through the other company and then connect it to us. And what ended up happening was we just had so many people wanting to use it, we ended up cutting a deal with Sierra so that their software is bundled in with our version of our program, and we do the support for it ourselves. So we do a very good job supporting Sierra. It's a phenomenal program. One of the best parts about Sierra that we'll highlight a little bit today is that you could do some things in it that you would find you'd have to pay for on other vendors' programs, or worse yet, you have to be a developer in order to get even halfway there. So one of the things I love about this program is that there are some things that if you can verbalize or speak logically about the things that you're looking for, more than likely there is a way to get that information displayed on your charts without having to pay a third party to develop it for you. There's nothing wrong with paying for education or software from time to time, but the problem is not necessarily the indicator, we believe. And there's some competitors of ours who have really gone down the road of convincing the trading community that their lack of success can be attributed to their lack of indicators, and we just don't believe that to be the case. So when I say in the description of the event that the goal of these types of events is simplicity and clarity, that is the truth. And one of the things we like to show in Sierra is how you can take data points out of charts that you typically really like to look at and put them onto a chart screen that can really be simplified, meaning you don't have to keep all those time frames or all those indicators up all the time, chewing away at your brain power. All right, so that's what we're after. If you don't see the video, you should be able to see my chart right now. So if you don't see it, try maybe logging off and back in because it's definitely up. All right. All right, so what I did was for this, if you weren't here last week, what you're gonna see are a bunch of chart books here that we've put together that are related to profile and order flow. And some of these are slightly modified versions of things we did last week, and some of them are new. So like this one we're looking at here is new. And what I would like to do first is go through some of the things that people usually look for with respect to profile or order flow style charts. And then we're going to make an effort to show you how you can get that same get those same data points, get their same idea without the complexity that you might normally think you have to deal with to get that data. All right, that sounded a little off and unrehearsed. It's because it was. But in other words, some of these things look really complicated and they don't have to be. All right, that's the long and short of it. All right, no pun intended. So the first thing I'd like to do is focus on this TPO basic. So this might look familiar because we did show some of this last week, but on the left-hand side of the screen here, you're going to see a TPO profile chart or market profile chart. So if I were to zoom us in just a little bit, you're going to see a profile that will probably look familiar. You've got the letters that represent 30-minute blocks. This gray area, this light gray area, is the value area based on time. All right, this pink extension here, that's the point of control based on time. And then over here, you've got a volume profile, and it's got similar attributes, although you can see the point of control from a volume perspective is actually down here. And the value area is a little bit, has a slightly wider range based on volume than it does based on time. So there's some reasons why all that is, but the point of me showing this type of a screen is to show you that you can get if one way to look at this information and get the information you need is to look at the TPO profile chart itself. One thing that we've noticed about TPO profile chart users in general is that they tend to trade on a little bit of a longer time frame. That doesn't necessarily mean that they're better traders, but what it does tend to point towards is that they tend to be a little bit more patient because these charts take a long time to form. And so there's just less opportunities. The less bars or the less signals you have, the less trades you're going to take. And you might find that if you are actively or over trading your account, you might be predisposed towards that sort of instant gratification that is associated with day trading and therefore already be at an instant disadvantage. So if you find yourself over trading your account, one way to try to combat that, if that's your predisposition, is to look or do a style of charting that just takes a long time for things to work. And it may force you to take fewer trades. So, there's a chicken or the egg conversation here with respect to does profile trading make people a better trader, or are people a better trader or are people using profile because of their predisposition towards patience? It's sort of hard to tell. But anyway, going back to the chart itself here, the most important data points that TPO profile traders or market profile traders typically look at are the value area, which we just talked about, the point of control, the initial balance, which is this blue line right here, okay, this range of prices, and then the current price, which you can see this little red arrow is noted by that. Okay, that's 67.09, the current price. All right, Steve, I'm sorry, the video is working, my friend. I feel like it's up, so maybe try a different web browser there if you can. All right. All right, so these are the things typically that a profile trader is looking for. Now, what I'm going to try to do, and this is sort of what we did last time as well, we're going to rehash some of it, is to show you how you can get these data points on regular charts. Okay, so the first thing that we're going to talk about is this initial balance setup. All right, so I did put together another chart last time that focused on initial balance. So initial balance is usually considered the first hour range based on the New York stock market open. So we all know that these markets the indexes in particular, open up at 5 p.m. Central Time in the evening. But most people really start looking at the market after the New York stock market opens at 8:30 Central, 9:30 Eastern. So there's a study that you can add to your chart called initial balance. And in the settings section, you can configure the start and end time. Okay. And you can also choose the option to have some extensions put out there. So when you see this initial balance mid, that's IB mid, that's the midpoint of the initial balance, the IB low, the IB high, and then here you've got a 50% extension of the high and a 50% extension of the low. It's kind of like when people look at either pivot points or Fibonacci extensions or something where you're sort of looking for the market to make a multiple of, or a portion of a multiple of something it's already done. It's a very similar concept. These numbers, I wouldn't say that they're the most important values out there, but lots of profile style traders who trade very heavily do use these values, and so it doesn't necessarily hurt to know that they exist. And we're going to incorporate them in a couple of other examples on how somebody could use this data to formulate either a trading signal or potentially even an automated trade. But for those of you who are wondering, if you want to look at the TPO, the initial balance, you don't necessarily need to look at a TPO chart to get that. You can get that in Sierra using an independent study called initial balance. Okay, it's just in the list here, just like a moving average. All right. Okay, now let's see. Profile traders versus order flow traders. I mean, they're typically it's very two very different ways of looking at the market, but we do find that there are, there is like if you were to draw a Venn diagram of these, these two types of market analysis, there's a large portion of concepts that interact or overlap each other. And so a lot of times when we talk about order flow or we talk about profile, we're talking about both of those things. And that's why we sort of lump these events together. What I would like to cover is sort of a permutation of something we did last week about the order flow study examples. I did flip a couple things around as the market was obviously looking very strong on the starting last night. And I'd like to show you what we have here up on the screen and how somebody can get here. All right. So what I'm going to first do is explain, what we have on the screen, and we're going to go through, how we get to this point. And then I'm also going to show you some of these examples with respect to how you can code your own alerts or signals that can be either acted on manually by you or done in sort of an automated format. So what we're looking at on this chart is the same as the prior chart we were looking at. So we've got the extensions and the initial balance here. Then below that, we've got the bid-ask volume ratio. We've got the ask volume different bars. All right. Now I'm gonna ask you to take a mental sort of screenshot of this. Okay. And I'm gonna flip us over to this order flow example chart that I had up at the beginning of the screen. All right. And when people talk about order flow, they usually use this name or this way to describe this type of a chart called like a footprint chart or a delta chart. All right, has everybody here heard that term thrown around, in the context of order flow trading, delta, bid-ask volume, that sort of thing? If you have, then you've probably seen something that looks like this or similar to this. All right, so just to describe what is on the screen, all right, let's go through that briefly, and then we're gonna flip back to the other side. So this chart here, let's look at this particular bar, okay? So the red thing you see around here, all right, this is the body of this candle. This is a down candle. So the fact that there's a red box here, this represents the body. Up here would be the wick if this were a candlestick chart, and then this would be the wick on the lower side if this were a candlestick chart. Okay, the bar to the right of that is a green outline. So you can see that would have been an up candle. All right, the little magenta thing you see here circled or put in a rectangle on each of these is the point of control of the candle itself. And then at the top, you're either going to see a blue encapsulation here with a line off to the right, or an orange one at the bottom with a line off to the right, or none. And what that basically is an indication that there's a theory that the market is likely to return to a price that doesn't have a bid-ask volume up here of 0 on one side. So if there's no 0 at the bottom, then you're going to see one of those lines coming over to the right. So what you see on the left are the number of contracts on the bid. What you see on the right are the number of contracts that were executed at the offer. All right, and then you're going to see some of them are red and some of them are green. And when you see a red number, that means that this bid was traded on significantly heavily compared to this offer. So there were 77 contracts traded here. There were 22 contracts traded on the corresponding offer. So when you look at these two prices, you're always looking at the bid versus the ask. So the bid here versus the ask here. This one here is significantly red as well. Okay, 108 contracts traded on the bid, 29 traded on the offer. And what's happening is the red is showing up when there's a certain percentage threshold met of a ratio of this number to this number. I believe in this case I have it set to at least 3 times. So if this is 300% of this, then we're going to get the red indication. All right, look at this candle over here. Okay, this one's a little bit different. See, this one's 4 contracts on the bid. This one's 32 contracts on the offer. Therefore, the offer quantity of 32 is increased. Okay, we just formed a new bar, so we're just moving over here. All right, so that is, that's what those numbers actually represent. All right, yeah, David, thank you. People will consider this to be the term to describe this when you see a price level that has at the top or the bottom of a candle that has no 0 on either side. They consider it an unfinished auction, meaning the market is likely to return there because not all the buyers or sellers were satisfied. Okay, that's an oversimplification of that idea, but that's what that means. All right, and then I also added another study onto this chart. This study here is called the numbers bar study. Okay, and then I added another one called a large volume trade indicator, and I set it to be 50 contracts on the NASDAQ. Okay, this is a 15-minute chart of the NASDAQ. So if there's a 50-lot trade that the charts pick up, it puts a little sort of transparent ball in the background. All right, so you can see here that there's a 50-lot traded here somewhere. And then you have obviously you have the ability to control that threshold, and you can make it bigger for the S&P and smaller for gold or crude, etc. All right, so what is happening is order flow traders are looking at this information. All right, they're looking at all these prices. They're looking at the bid versus the offer. The color is changing. There's a lot of information here. And because order flow traders tend to be looking at things on a very granular level, they tend to trade a lot because order flow traders, not all, but a lot of order flow traders I talk to, they're trying to win sort of like a technology game. And in my opinion, that's a very difficult game to win when you don't have the resources that the big companies and automated algorithms and so forth have. All right, there's probably not a lot of people here who can pay the exchange $100,000 a month to co-locate their server at the exchange, right? So I mean, you could make the argument that if you try to fight that battle, that you're not going to be able to do it. But the people who are really big proponents of order flow trading say that it's really not about that. It's about looking for tendencies in the market that are based on bid volume versus offer volume and the relationship between those two things. And since this data is made public, why can't we as regular people who don't have access to those insane resources use this information to our attempted advantage? All right, so that's would be the point counterpoint. My opinion, okay, as being someone who's been in this side of the business for a while and seen a lot of people come and go, and I've seen people succeed and fail for many, many years, is that there are certain things about bid offer volume and the relationship between the two that really can be useful. The only issue I think is that this style of trading tends to attract people who are predispositioned to failure, because it does look at things on such a granular level, and people try to go down that road, and I think that's generally speaking a mistake. That's why I'm showing a chart right now that has a 15-minute time frame. There's probably not a lot of order flow traders here who look at 15-minute candles. They're going to look at 6-tick range bars. They're going to look at 1-minute charts, and I like to use some of those examples too to demonstrate the mechanics of the program. But you trade on a 1-minute chart or a 55-tick chart or something, I don't care what you're doing, you're going to get a lot of trade signals or opportunities, and that may not always work to your benefit. All right, so this chart template, if anybody wants access to this or any of the templates we're covering today, just send an email to your rep in our office. We'll make sure to get them to you. So you can use them on your own. You can work backwards off of them. You can break them down, take pieces of them, do whatever it is you want. You're 100% welcome to have them. Just again, email the request to your rep and we'll get them over to you. All right. But the point of me showing this is to show you, as we go back to this order flow example study, that there are ways to get information about order flow tendencies without necessarily looking at that type of a screen. There are two studies at the bottom of this chart. One is the bid-ask volume ratio, and this one is the ask volume difference bars that display this information in a very concise way. It's definitely not as granular. You're not looking at individual prices. All right, you're looking at a more macro picture here because you're looking at the bid volume versus the offer volume displayed as a ratio that can be graphed like a moving average or on any kind of other oscillator. And then down here, you've got the ask volume difference bars, otherwise known as delta. And it's basically showing a positive number if there's more volume done on the offer than on the bid. That'd be considered bullish in its most basic explanation. Or if it's going negative, that means there's more volume done on the bid than the offer. Therefore, the bar is negative, and that is a bearish tendency. Again, very simple explanation. What you see up here in the top are the high and low values of this indicator down here. All right, so if the ask volume difference bar gets to 8, like where it is now, it's going to show 8 up here until it breaks 8. All right, so that's what this is doing. That's a study called Text Display for Study. That's a really easy study to add. You just add text display for study, and then inside the settings section, you just configure it of what is it displaying, and then you can change the colors and where it's located and stuff like that. So this is a great study, the text display for study. It's a great study to use if you like to know the value of an indicator without necessarily wanting to have the indicator sitting on your screen, taking up space, and chewing up your eyeballs, okay? So if there's something you really like just to see the value of, like I like to look at the CCI. I'll talk about an example of that in a minute. Sometimes I don't really need the CCI to be visible. I just need to know when it's over 200 or less than negative 200. This is an example of how to configure the chart to display that information in an efficient manner. All right. we're going to minimize the chart here on the right for now. I just want to focus on this one, and how we'll explain now how we get there. All right. Now, what I was looking for in this example is I was trying to come up with a series of conditions that could point me in the right direction of a trend, or the beginning of a trend, or even the continuation of a trend when the market was looking strong. So last week we did one with a bunch of bearish conditions. And what I did this last night and part of this morning is, as the market was looking strong, I started tweaking things and looking for something that's going to show me an example of when the market might be looking to continue in one direction. So let's go through how we're getting this blue bar up here. All right, the blue bar in the background is a signal that I created. Anybody can create these, and all you need to do is learn a little bit about how Sierra's syntax works. And we're going to go through some examples of that here, and then I'd like you to take that with you on your own. And next week or whenever we could reconvene, we can hopefully you have learned at least something about how to recreate this type of a setup on your own. And again, you can use the chart file in conjunction with the recording. You can probably get a lot done in a week. All right, so what I was looking for in this example is to add a study called the color background based on alert condition. So color background based on alert condition is a study. It's not like a moving average where you just add it and click apply and OK, and all of a sudden it's working. We actually have to provide some conditions for how to make this study do what we want it to do. And what I decided as I was looking at the market is I was trying to figure out a way where I could be notified when a series of conditions were true. And here's what the conditions were. All right, the first condition, and I'm going to show you what's going to look like some gobbledygook here in a minute. It's going to be a bunch of code. All right, the first condition was that the market had to be above the initial balance midpoint. All right, that's this blue line. So I told myself, in this situation I wanted to look for longs, I want to make sure that the market is generally above where it started when the New York stock market opened, especially on a Monday. All right, so I know we had a strong opening last night. What I didn't want to see is the market start tanking, and then this system starting to give me buy signals just because the market was falling, because the market was falling and potentially giving back everything it had made so early on in the week. There's not really much conviction yet, and I wanted to make sure that we're filtering out the idea that we could be going long if the market starts to give this all back right on the open, which it felt like it almost did. Obviously it didn't, but that was my first condition. The second condition is, given that this would have been a short-term trade, I was looking for a positive bid-ask volume ratio, meaning this blue line had to be above the black line. Okay, so we wanted a positive bid-ask volume ratio. And then down here, the ask bid volume difference bar also was going to be positive. So these two things are a little bit redundant, okay, but I'm putting them both up here so that we can show you how to create a condition that is really encapsulating several conditions. All right, so when you look at the code on this color background study, and you look at this for the first time, obviously that can be disconcerting. All right, you might say, well, I thought you said this was going to be easy. Okay, this looks tough. It's actually really not at all, because we are going to break these little things into pieces, explain them, and just show you how to plug them all together. So nobody just opens up this window and starts typing in this code, like this, like you see in the movies. It's not like that at all. What I like to do is use Notepad, and I just sort of walk through it step by step, and I'm going to do that now. And I'd like you to follow along as best you can, but I'd also like you to start thinking about the things you look at, or the things that, as a customer or a trader, that if you had the ability to sort of show when all of these things were true, what would those things be? What are the filters you look for currently? Like, what do you feel is giving you the closest edge? What is a situation where there's 4 or 5 things that if they line up, you would want to be notified? You don't necessarily have to take the trade, but it sure would be nice if those 4 or 5 things, if they were all true together, you could be told immediately by the program faster than you'd be able to realize it on your own. All right, that's really the point of the exercise. Okay, what I'm showing here is just an example. All right, you're free to use it, as much or little as you like. All right, so let me just throw Notepad up here real quick. And I use Notepad because I just like to have some notes. It's easy for me to keep track of some of these identifiers that we're going to use. All right, and let's go through and explain, how we get to this point. All right, so the first thing that we talked about was the market needs to be above the IB mid. That was step number 1. So when I'm trying to tell the charts that that's a condition I'm looking for, how do you think that I do that? You don't just type in the box if the market is above the IB mid, right? We have to do something that the computer will understand. And the way that we do that is to look for an ID number at the beginning of each study. So in this case, the initial balance ID number is 3. All right, and when we go to the settings section and we go to the subgraphs tab, this is where we can see what each of these subgraphs numbers are. In this case, the IB mid is subgraph number 8. All right, so we have ID3, SG8. So the way that we're going to refer to the IB mid is going to be ID3.SG8 like this. So in that code, as we put it together, this is the value that we're looking for. All right. Okay, now the next thing is we're going to look for a positive bid-ask volume ratio. All right, and then we're going to look at positive ask-bid volume bars. So the idea here is to, we're going to go through each of these conditions one by one. Let me check one thing here really quick. Okay, all right, you know what? Actually, now that I think about it, I remember revising this morning because I'm looking at this and I'm actually realizing that I was actually trying to be a little bit more specific. I actually wanted to only see this thing happen if we were above that IB high, which is right up here, not the IB mid. So the IB mid yielded way too many true responses. So I do remember that. That was a little bit different than last week. So I'm going to amend my statement here a little bit. If we go to the color background based on alert condition, you can see, in fact, I was using subgraph number 7 here. And so I'll explain, how we got there. All right, so the IB mid, ID3, the IB high is actually subgraph number 7. So let's change this here. So we actually want to see some conviction on this. The IB high is going to be ID3, SG7. So that's one of the conditions we're looking for. All right, now in order to tell the chart that we need the current price to be above this indicator in order for the condition to be true, this is how we're going to do that. You're just going to use C for the current price or the closing price of a bar. So as we're looking at history, back in history on the chart, we're using C as the closing price. Or if we're looking at the current bar, it's the current price. So it's just going to be C greater than ID3.SG7. This means price is greater than IB high. All right, that's the first condition we were looking for. The second condition we were looking for is a positive bid-ask volume ratio. So you see an ID number there. All right, that's ID1. Let's go to the settings and look at the subgraphs. So we have volume ratio average is 1, SG1, and the 0 line is SG2. All right, so SG1 and SG2. So in order for us to tell the chart that we want the volume ratio average to be greater than the 0 line, that one doesn't seem like it's too difficult. But again, just for the sake of demonstration, we could make our notes. We could say ID, so we're, the volume ratio is going to be ID1.SG1, and then the 0 line is going to be ID1.SG2. So the way that we're going to use this code is going to be just like you'd expect. All right, there's a lot of copy pasting in this business. Okay, so it's going to be ID1.SG1 is greater than ID1.SG2. That means that the vol ratio average is greater than 0. That's their second condition. All right, so ID1.SG1 is greater than ID1.SG2. All right, and then our final condition in this case is that the ask bid volume difference bars is greater than 0. So if we go to the ask bid volume difference bars, all right, we're looking in this case for the close value, meaning the current or the current value if it's the current bar, or the close value if it's a prior bar. So we have ID2.SG4. Okay, ID2.SG4. So for ask bid volume, that's going to be ID2.SG4. Oops, let me put a period there. All right, ID2.SG4. All right, now the value, the way that I was using this particular study, it allows us to introduce a concept that we really hadn't discussed yet. And if we look at the actual color background here, what we're actually using is we're not necessarily looking for a positive number. We're just looking for a number greater than the prior bar's similar value. So in other words, we want the ask bid volume difference to be greater than the ask bid volume difference in the prior bar. Not necessarily a positive bar. It could be a negative bar, but as long as it's less negative than the prior one, that would be okay too, at least for the sake of this example. So ID2.SG4 is greater than ID2.SG4 with the -1 in brackets. This is how we specify to the charting program that we want to look at the same study. We just want to look at a comparison between the current bar and 1 bar ago. So if we were again writing that out like this, we would say, okay, for the condition of for the ask bid volume difference, we would say ID2.SG4 greater than ID2.SG4 with a -1 in brackets. And this means that the ask bid vol difference greater in current bar than 1 bar ago. All right, so these are the 3 conditions we're looking for. So what you'd want to do is go through this process for each one of the studies. And once you have them all together, then all you need to do is put them all in a row and separate them with a comma. So here's our first one. You can have spaces after, it doesn't, that part doesn't really matter. Here's our second one. And here's our third one. And once you put them all together like this, you just put a giant parentheses around the whole thing and encapsulate it with a giant parentheses around the whole thing, and then the word "and" at the front. And that text goes right in here. So it is a process. It's not like this happens immediately, but once you start getting the hang of how these identifiers work and what the conditions are, you'll find that you can create these signals very, very easily. And you can actually get Sierra allows you, if you can, again, verbalize logically the types of things that you're looking to view, you'd be surprised how creative you can get with this. All right. I'd like to show you an example of something I made earlier today. And again, this is just for the sake of demonstration, but it's kind of a neat idea. All right. There's a study that you can display inside Sierra called Numbers Bars Calculated Values. So Numbers Bars Calculated Values would be great for somebody who needs the data that you see in the bottom of the chart like this. They don't really care to have the chart look like this. Okay, so you're interested in the values related to the bar itself, but you don't necessarily want the bar to look like this. All right, this study is a great example of a way where you can get bid-ask volume data without having to change the entire structure of the chart. So what you do is you add a study here that's called Numbers Bars Calculated Values. And in the settings section, you're going to see under subgraphs, there are like 40 different choices. Okay, some of them get pretty intense, but most of them default to draw style is set to ignore. Okay, ignore. So what you do is you go through these and you pick the ones you would want to be visible. So the ask volume, bid volume difference, otherwise known as the delta, that's the first and most obvious choice. I have that set to visible. So if I look down here at the bottom of the screen, I see this one has 3,061. That is a significantly bullish value, all right, under certain circumstances. So you can right-click studies. Again, go add the study called numbers bars calculated values, and then you can see all the ones that are available in here. So the ones I've got visible are the ask bid volume difference, the ask bid volume total, which is really just the total volume, and then you've got the ask volume total, all right, the bid volume total, the maximum ask volume bid volume difference. So this is the highest value that the delta has been inside the bar. So the highest that the delta that you've seen inside the bar, and then you also could display the minimum, which I actually don't have here, but we could, you know what, let's go ahead and display that. I'll make that one a negative or a red color. Let's apply it real quick. Okay, so there's the minimum ask volume bid volume difference. So the lowest the delta has been in this candle. The total volume traded, which is a little redundant, but it's there anyway. And then this was an interesting one, volume per second. Okay, so again, that's a pretty granular way of looking at the market. The idea being that you can see, you know, how much volume is being traded every second. Okay, roughly. I'm sure these numbers, you know, vary a little bit from one data provider to the next, but again, it's pretty granular data. But that's kind of a neat thing, and actually, it's something I incorporated in the condition that is showing the blue stuff on the background. All right. So yeah, as far as the cumulative choices, David, I believe there's cumulative sum of ask and bid volume difference on the day. That's one choice. There's a whole bunch of other cumulative choices as well. Cumulative delta volume high, cumulative delta volume low. So I'm sure you can find what you're looking for in there. At least I would hope so. Cumulative volume day. All right. So going back to the color background study, what I was trying to do in this case is I created a study, and I was looking for two things. The first is I wanted the delta to be greater than 150, and I wanted to see more than 25 contracts being traded per second. So what I'm picturing as I'm writing these conditions is I want to see the delta start to get bullish, all right, although that's not very bullish, it's barely bullish. And then I wanted to see, I was looking to see how, you know, what was a typical value in this volume per second here. And there are some values that are 13, 17, 15, 10. You know, there's just not as much activity occurring. I was looking for the market to pick up again in the amount of activity that we were seeing to the long side. So I wanted to see, I thought maybe this thing could really get running. So we were looking for a positive delta and then a relatively high volume per second value. So you could whittle this down. I mean, if you get too many signals based on the studies that you're using, the conditions you're using, you could reduce the value or change or increase the value so it's harder for both the conditions to be true. So as an example, if I want to change this to 250, I might see a change, or actually I don't think I'll see much of one. Let's change it to 1,000. Okay, so you can see a couple of them go away. All right, they're no longer true. All right, when they were at 150, like this, you know, it's a little bit more liberal. Okay, there's more included. But in this case here, you know, if you feel like, okay, I'm getting way too many signals, one way to do that is to filter out, you know, some of the stuff that you might, you know, wanted to have avoided in the first place by increasing how stringent the signals are. All right, if I want to do it again here, I can increase this volume per second, say to 30. Okay, a couple more go away. So it doesn't necessarily mean you're filtering out only the bad stuff, but if you feel like there's too much noise, you have the ability to make the conditions a little harder to be true or untrue. All right, so that is another example of, you know, how somebody can use this. So the general concept with the order flow stuff is that if you want to get really granular, you have the ability to do it. You don't need to go pay $7,500 for an order flow mechanism. All right, there is so much available natively inside Sierra without any type of extra cost that you can probably do everything you want to do in here. There are a couple of companies that we hope to do some events with here in the near future who have done a really good job with some order flow tools inside Sierra that are actually very, very reasonably priced. So we don't necessarily have a problem with, you know, people selling tools and add-ons for charts. I mean, there's nothing wrong with that. But, you know, we don't want to see people being told that, you know, if they spend, you know, $7,500, let's say, on this particular order flow tool, that's the answer. We just don't want to portray it that way. It's a big deal, you know, for us for many reasons. But there are a couple of really good add-ons out there you can get. But there's a lot of stuff you can do inside Sierra natively as well. And if you are a developer or a programmer by trade, then you can really have some fun with it. But even people like me who are not, you can still do quite a bit. Right. Okay, so I did want to go back to the value area breach project here that I've been talking about from time to time, because there were some, to me, this is not really an order flow mechanism, but it does take two of the most important pieces of market profile, the value area high and value area low into account, which I think are, really interesting, ways to look at the market. I would like to explain this because I did run this today. These are simulated trades. There were a couple of mistakes made. I actually want to talk about why those mistakes were made and put that in the context of the fact that we're human and we make mistakes. And in some cases they can be costly, but I would like to show briefly how this program works. So most of you are probably to some degree familiar with this concept, but the general idea here, for those of you who are curious, and I'll just zoom into like a very clear example here on the NASDAQ chart. So these charts are all linked together by scrolling, so I know it's kind of hard to see where I'm at, but I'm on the NASDAQ chart right up here. Okay, the 5-minute, you can see this red arrow come down. All right, this red arrow with the red background. All right, so what you're going to see happen there is you're going to see the market reaching up through this value area high. All right, reaching up through the value area high. And then in the same candle, the market, the CCI down here at the bottom is breaching a positive 200. All right, this is where the reference I made earlier to Sierra, or to the CCI comes into play. So the signal with this strategy, which is, there's some context here that I need to make sure I explain, is that the market breaches the value area high, which at the time was this green dotted line. Okay, the solid green line is where it is now, just kind of painted backwards in time. The dotted green line is where it was at the time. So the market goes up through the value area high, and at the same time, the CCI is extremely high, and this is a counter trend strategy. So the idea here with this strategy is that if the market rips up through this level, and the CCI is an extreme number like 200, it has a tendency to break back down towards the mean. It doesn't always happen. In this example, I don't think that this trade would have been taken. The reason is because if the market is already as high as it was this morning, if I were running the system in a live account, I probably would have shut it off, at least before the market opened. So I don't want to claim responsibility for taken this trade or told someone to take it live or anything like that. This one may have been skipped. There's another thing that I have incorporated lately in light of the extreme volatility we've seen. And I'm not going to explain all of everything that's on here because some of this stuff is not really related to the actual order execution. But this AutoSell study that has the study on here, this is actually, see this very last piece here? This is actually saying that not only does the market have to breach the value area, but it has to do it by 5 full points. So in the NASDAQ, that's 20 ticks. So you can see that in this case, this probably wouldn't have even been taken even if I did have the system on. I mean, maybe it would have. Would have been close. But the idea here is I found that the system was early. Like the value area would get punched through and then the CCI would spike up. And a lot of times I'd be right, the market would come back down, but I could have saved myself $100 per contract in the NASDAQ had I allowed the system to punch through it a little higher before I actually would take the short position. So there is risk to that also, in that if the market goes up through the value area just a little bit, I might miss it, right? That might have happened here had I been running it this early, which I was not. But this is a really interesting strategy because a lot of times you see this value area being breached like this in this type of a market where it's trending and then it's choppy and then it's trending and it's choppy. People often struggle with this type of a market, and this is something where if there's not a lot of conviction, there are plenty of opportunities to take trades based on something like this. The risk to trading in this sort of fashion is that you could have gotten short the market up here and then it literally just never comes back, and the market, the S&P is up 38 points at the close, and you either hung on to it and got your head ripped off, or you took a hit, you took a loss. So if you're going to trade a counter trend strategy, you need to be prepared to take some heat. And one way to do that is to either have a properly funded account or to be very judicious about the position size, trade a one lot. It's way better. I tell people all the time, this idea. It's way better to, if you're going to risk, let's say you trade the Nasdaq, you can risk 20 full points on the Nasdaq and only lose $400. I mean, if you're going to lose $400, do it on a one lot. Don't do it on 48 round turns. Okay, as much as that works out for us at Infinity in the short run, you're not going to be around long. We'd rather have you around. So, when the market gets volatile like this, the general, recommendation that you hear, this very vanilla recommendation is, well, you should just reduce your position size. But we want to understand how valuable that is. Right? In a market like this, it is very valuable because people should go in a capital preservation mode in this type of a market. And be judicious with the size. So there are also the other problem with this type of a study is that, let's look at this S&P one over here for a minute. I'm just going to make this a little bit bigger. Is that sometimes a signal is true and then becomes untrue. So like down here, the market went lower, punches through the value area low barely. All right, the CCI touches that negative 200. The system goes long, and it's in a great trade. And then I ended up putting a stop in manually over here, and this gets stopped out. So that's a $312 winner on a one lot trade. It's it's a simulated trade, so bear that in mind. But this is what happened. This exit was done by me manually. It was obviously premature. I shouldn't have gotten stopped out there, but I put something in at some point. I don't like to trail stops very tightly. I think that if you're going to make money at this, every now and then you got to catch a runner that lasts the whole day. It's the only way to pay for your mistakes. And people who tell you to trade, to trail the stop by, 3 ticks or something like that, I think it's very hard to catch a long running winner that way. All right, that's just my opinion. But this is an example of how quickly this can happen. There's no possible way I would have been able to take this trade manually. There's no way it would have happened. So that's kind of a neat example. Another thing that, when you're trading a strategy like this, sometimes you'll get a short signal while you're in a long position. And that's a good time to start thinking about, a stop as well. Like here, if you were in this trade in a live account, you would have gotten a short signal while you were in the long position. And that could have been a heads up to, all right, the market is now rallied. It's broken its value area high. After breaking the value area low, there's a chance it keeps running, but it may get exhausted, and you should bear that in mind. So that was kind of a neat thing to see that happen. There were a few different signals in the Nasdaq today. This one didn't really pan out. This one here in the Dow, let's make the Dow a little bit bigger. So let's go like this. Okay, so this one in the Dow, this one was taken. So this one here, the market goes up through the value area high. You can see the CCI gets touched, the system gets short. I think I covered this one manually as well at this price here. So that's it's a pretty small winner. This one here should never have been taken, but I let the system. I forgot to turn the system off, and it got taken, and it was a bad one. So like this one here, the market goes to the value area high. Look how strong it was. It just didn't even look back. Okay. And, the CCI had done its thing. It was above 200. So why can I look you in the face and tell you that this trade shouldn't have been taken? It's because when all the markets are up like this, especially as the day goes on, that value area is harder and harder to break just from a mathematical standpoint, because more and more contracts need to trade in order for a new value area to be established. If you're looking at these markets and you see a short signal and all 4 of the markets are just ripping higher, don't go short. Okay, it's usually when there's an outlier or when the move feels very temporary. Does this sort of a system work best? Like to me, so these entries in the morning were very, very easy. They happened right around the open. The market was up. It looked like it was coming down a little bit. There was no bad news at 8:30. It just kind of petered out for a second. That to me looked like a great place to be long. All right, but and again, there's some context and subjectivity there. But with respect to going short the market or going long the market, if you're looking at all 4 of the indexes and they're all ripping lower at the first time, all at the same time, you probably don't want to get long. But if one of them or 2 of them are out of whack and there feels like there's some indecision, that's usually when you get this muddled sort of reversion to the mean type trade that most traders consider that chop. Oh, I got chopped up, or I can't trade this chop. The chop is great for this type of a strategy. All right, here's the Russell. Okay, Russell was another interesting one today. This out of the way here. So this one was the early morning trade, didn't get taken. This one here was taken automatically. Okay, so the market goes down, barely breaches the value area low. This is right around the open. CCI hits negative 200, and then it just, you take a little bit of heat. The Russell's only $50 a point now, right? So it's a good market for those of you who want a little bit of a smaller place to start. And then it just comes running back up. And I don't know if I feel this one here, I accidentally bought a second one instead of getting flat. So even brokers do that, right? So I bought a second one and I covered them both right away. So that turned out to be a great one. So the small caps have been really fun to watch lately. So the reason I'm showing all this stuff is because I think that it's fun to give cool ideas to people about trading when I don't have to sell them to you. It's all public free stuff, and I want my clients to make money. And secondly, it takes it shows you that a regular person who is not, I'm not a technician by trade, I'm not an order flow guy, admittedly, but I like to look at certain aspects of trading and indicators that I think are valuable, like the value area, but I don't necessarily need the full, itemized volume profile, on every single candle to get what I want out of this type of an idea. I could just look at the value area high and the value area low, and that's it. I have a little volume profile up here. You can see that. I make it purposefully almost transparent, so I barely ever see it. The only thing I ever look for is if there's a really, really steep valley somewhere, like if the market is coming down through this area here and there's barely any volume having traded there in this session, sometimes you'll see the market punch through those values. So that could impact my desire to be long or short, at or around that price. All right, but it's not something I'm sitting here itemizing on a daily basis. So I think it's kind of a neat way of looking at things. Over here on the right, I'm always looking for ways to fine tune the entries. Some people use the tick from the NYSE. If the market is going, let's say that they're looking for a good short and they see the market ripping up through that value area high and the tick starts punching above 800 or getting close to 1,000. There's a common trade taught, in all kinds of places all over the internet called the tick fade, where that could be an especially good short because usually the market doesn't sustain that tick value being that high for very long. So the CCI is overbought. The tick NYSE tick is looking really hot to the point where it's going to peter out, and that value area high gets broken. And in that particular moment, maybe only one or two of the indexes are breaching that high area. To me, that's like a really good possibility for a short, and that would be worth the risk. That'd be worth risking 60 points in the Dow. It's $300, on a one lot. You can risk 60 full points on the Dow and only lose $300. It's a great, looking at it that way. It kind of relieves you as a trader of some responsibility of, having to use some tight stop because that's what everybody tells you have to do. You don't have to do that. You can use a nice wide stop, trade fewer contracts, make less decisions, look for a couple of good ones. And, this is, I know it's a 5-minute bar that we're looking at, but, you're not going to get a signal every few seconds. All right, down here, the yen, bonds, and crude. Crude's going to become a factor again, soon. If crude starts breaking $70, there's going to start to be, the relationship between crude and the S&P will invert again to the point where, if crude starts really running, that, people might get concerned, and you might start to see the market ratchet up, ratchet down as crude ratchets up. And, that was originally when I first started looking at this style of looking at the market. I had crude on the chart because crude was down at like $35, and every time crude would fall, the market would tank with it because it was worried about the energy stock. So if you had a long position signal come, but crude was breaking, you wouldn't take it because you don't want to step in front of that crude oil, freight train, so to speak. So being aware of the interaction between some of these other markets is often, very valuable. They're not always moving in tandem, or they're not always moving in that inverse relationship. That'd be great if they did, or if they would tell us in advance when they were going to, shift their relationship. They don't tell us. So, being aware of how these other things impact, the market is important. Bonds, obviously, a flight to quality. The yen looks really similar on this chart to bonds, right? Because it is also considered a flight to quality. So if you see the market, let's say you see, the market falling, and and the yen is going higher. That could be a continuation, on the sell side, okay? Because if the yen's making a new high, that means money is probably pouring out of the stock market into the yen. So, that could take you out of or keep you out of a potentially bad long. Just like keeping you out of the S&P if crude were at $35 and it was going lower could keep you out of a potentially bad long. So that is, that's what this chart on the right is. This is the part of the chart that I think changes the most. All right, I'm always trying to keep an eye on things, trying to figure out what's moving what's the relationship between this, that, and the other thing. It never ends. It's a constant battle, but the program makes it pretty easy to do. So this is done using a couple of studies called. This one is study price overlay. So you can use study price overlay to overlay other markets onto charts, and I have these in region 2, 3, and 4. And I also disabled the auto trade on this particular chart book. So if anybody wants a copy of this, you'll notice if you go to the auto sell or auto buy studies here, which are my actual trades, send orders to trade service is set to no. Okay, that means if you log into your live account and you have this on, even if a condition is true, it will not send the order to transact. So you won't get a signal unless you would change that. So if you change that, that's your prerogative to do that. But if you do want a copy of it, you're welcome to have it. All right. So all right. Well, I think that's probably where I will leave it for now. I've been talking all day, and obviously my voice is not where it normally is. So I apologize for that, but. Hopefully it was all clear, and hopefully you got something out of it. I know this is a huge topic, and it's really hard to get in 1 hour, entirely focused on things like order flow. But it is an interesting way of looking at things. I just want people to look at it in a way that jives with their personality. And I want you to be aware of your predispositions. Look at yourself honestly, introspectively, and say, look, am I looking at this order flow stuff because I like the fact that it gives me a trade every 30 seconds? If so, don't do it. You should be able to confront those realities, and hopefully we can help you do that, in an honest way. All right. So if you want a copy of the chart files, please feel free to reply to the emails that we send out, or just email your rep in our office. We'll get the file over to you and some instructions on how to import them properly. And if you want to try the program out, you're welcome to. There is some news coming, some good stuff with respect to this charting club. You've seen that on our website and so on. So there will be some updates coming with respect to the Sierra Charting Club, and what we're going to be doing with this going forward. The safest way I can say it would be it's going to be best for you if you're a customer of ours. All right. So please consider, if you're not a client or thinking about becoming a client. We're going to improve the content and make it better and better and better for those people who are customers of Infinity. It's kind of one of our ways of saying thank you for coming to these things. So we look forward to that as well. So please keep us in mind. Tell your buddies and friends, your trading groups online about Infinity and the degree to which we're willing to put effort to help our customers succeed. That's really a huge priority for us. It bodes well for all of us. It generates referrals for us and keeps our clients happy and content. So if you have some friends or colleagues or people who might be considering a brokerage company, or if they're unhappy with the current setup at this place or that place, please ask them to think of us. Obviously we'd love to impress them as well. All right. Alrighty, folks. Thanks again. I do appreciate it. We're going to sign out for now. We'll get the next one up on the calendar here within a week or so, and we'll take it from there. All right. I'm going to read some risk stuff one more time. Don't forget to email your rep in our office if you want copies of the files. We're happy to send them. Okay, folks. Alrighty, thank you, everybody. Appreciate that very much. We'll talk to you next time. Thank you. All right, folks. Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Okay, thanks again, everybody. See you next time.